Okay, good morning, everyone. Can we move on to the next slide, please? Morning, my name is James Russell. I am a Relationship Director from the Development Finance team. Today, this presentation we're doing is on development finance and explaining what LendInvest has to offer. I've also got my colleague, Mike Jessup here, if you want to introduce yourself, Mike.
Yeah, hi guys. So my name's Mike. I've been with the team about 3 years now. Recently moved to a relationship manager role. I was originally in a portfolio manager role. Those of you that were in the session that Steve and Gemma just presented, obviously got a breakdown of each individual role of the team. But James and myself obviously head up the relationship management team in the development side of the business.
Cheers, Mike. Okay, next slide, please. Right, so what we're going to do in this presentation is dig a bit deeper from what Steve touched on in the main presentation. We're looking to expand and explain exactly what LendInvest has to offer for development finance. If we can move on to the agenda slide, please. Cool. Okay, so in the agenda for this presentation, we're going to cover up the types of development finance. This will give a bit of a summary of what's been offered in the market and to show you exactly where LendInvest fits in. The key fundamentals of securing finance. So we'll explain to you what we look for and expect to see from the broker and introducer on each deal that you send into us. And then finally, our product. So we'll expand on the development finance product that we offer at LendInvest. If we can move on to the next slide, please, and then the slide after that. Right, so types of development finance. We have split this into 4 tiers of development funding that you can source in the market at the moment. I think important to note is obviously post-pandemic, this does look a lot different. Pre-pandemic, I'd say on average across the board, you'd add 5% on the leverage most funders were offering, but this is where they all sit at the moment. So tier 1, we have high street banks. We don't really see them being that active at the moment, certainly not into 10 million. I'm sure yourself as brokers will have a better feel for where they are and what they are offering at the moment. Tier 2, challenger banks, 55% loan to GDV, some at 60%, and loan to cost 80%. Fairly boring for the sort of senior debt for us. A couple of examples of these funders would be Close and United Trust Bank. And then moving on to tier 3, which is where LendInvest sits. This is the stretch senior tier, leverage up to 65% loan to GDV. Prior to the pandemic, we were offering up to 70%, but for now, we are staying at 65% loan to GDV. Some funders in this tier will cap their loan to cost at 85%. However, fortunately, in LendInvest, we do offer up to 90% loan to cost, which is a great selling point we have. Rates vary per funders as well, 7.5% to 12%. And then finally, in the alternative section, we've called it, is where you'd find your mezzanine and equity providers. This leverage and the terms here obviously vary on the timing and who's in the market. Across most of the senior funders, arrangement fees would be typically 2%, would include 1% to the broker, and exit fees range from 1% to 2%, and that can be applied against the loan amount or the GDV. Next slide, please.
So now we're just going to sort of break down, and I know there was a couple of similar questions that Steve briefly touched on if you were in the last presentation. The key fundamentals really that any funder, ourselves included, would look to get early sight of when securing a development finance facility or assessing a new development finance facility lead. Next slide, please. So the first one, and possibly the most key of them all, is developers' experience. We want to work with developers that ultimately know what they're doing, People that have a relevant track record. So our bog standard, I would say, is ideally a minimum of 3 schemes as a developer in their own right. We do get a lot of inquiries from building contractors that want to go out on their own. We can get comfortable with that, providing they can give us sufficient comfort that they are capable of undertaking not only the build phase itself, but also the exit phase. So be it a refinance or sales. And obviously that's where their relationship with brokers is very key, because there's often a partnership there between the broker and the developer to guide them in that. And that would provide us additional comfort. We want to work with people over a long period of time. We're keen to develop repeat business. We want to go on that journey with a lot of our developers. People that we've lent to before have started off with slightly smaller schemes, and they've scaled up as we've gained trust with them, and vice versa. That's definitely something that we look to do. So track record is very key, but we can certainly look at the longer term picture on that. Appropriate size and scale. So that's not just within the developer's means. Obviously that's important, but the size of the scheme needs to fit in with the local area. For example, if you're in a reasonably rural location, say in the southwest, it's unlikely that we're going to have appetite to fund a 100 apartment scheme. Clearly, it all has to tie in with the market liquidity, which James will touch on in a second. But obviously it does also need to fit in with what the developer's got experience in. The type of build that the developer's got experience in as well is also key. Developing in known location. So we're always keen to work with developers that have an existing presence in the area for which from which the inquiry that's come to us is from. We deal with a lot of regional developers, not just in the southeast. We deal with a number all around England, Scotland and Wales. And a key thing for us is that they've got the relevant connections in that area. So take, for example, good connections with sales agents, good connections with people that might source new development opportunities for them, a good relationship with the local supply chain, both in terms of materials and labour. And that's really a key point for us, because as you all know, lots can go wrong within a development scheme, and it always helps to have a knowledgeable local developer heading that up who can mitigate any of those risks much more easily. And finally, the suitable professional team. So that's not just about local professionals, it's also about professionals that have the relevant experience. This is probably as important as the actual developer at times. You need people that are sympathetic to the scheme itself. They have experience of working within these schemes, especially if it's a slightly quirkier scheme, for example. And that obviously helps in best case scenario, schemes going as smoothly as possible. Next slide, please.
So the next key fundamental that we're going to look for is market liquidity for the end product. So we want to know what you're delivering to the market is going to be in demand. We'll use the likes of Realise or Rightmove to see sort of evidence of similar stocks selling over the recent years to support that it is going to be in demand. We want to see this price suitably. We don't want to be setting new records for the pound per square foot, certainly not at capital value. We want a price that's comfortable for the area. So a good example of this, and it's what I typically do when I'm looking at a deal, is on the Rightmove sold data and descending it through the values. We want those price points to be a third down there. We don't want them to be at the very top or certainly above what is sold. That provides evidence to us and comfort that values around that point and above are selling in the local market. Next section is help to buy eligible. I guess this is more important than ever now with the new scheme coming into effect from March this year. If the product is going to fit within the new help to buy criteria, then that's going to be a strong scheme and be in good demand, particularly if you're going to get houses that are fitting within that criteria. As we know, with different locations throughout England, there's different price caps for that product now. The final one is a bit of a saying that we have, which is just every estate agent's window. This means we want to be delivering a product which is typical for the area and proven to be in demand. So if you're walking down the high street, you'd expect to see this in most estate agents' windows. Next slide, please.
Great. So the next section is cost appraisal. I guess the most appropriate word for this section is probably realistic. Obviously, that applies to most of the other sections. But ultimately, we want to see a developer that has thought out the numbers that they presented to us on the scheme and they're actually achievable. So starting with the build budget, obviously, clearly that needs to be realistic for the location. Obviously, different parts of UK are more expensive to build in than others. Again, as I mentioned before, supply chain can be slightly lower and that can cause issues with sourcing materials, especially in areas where there's a high density of developments going on. It also needs to be realistic for the spec of the scheme. If, for example, there's a scheme that's producing slightly more higher end units, then it should be taken into account that more money will need to be spent on things like kitchens and bathrooms and everything relating to that. So it needs to be in line with the scheme so that they have the best opportunity to meet the GDV that's been that we essentially rely against to lend. And also just generally a word, as we all know, we're in the middle of a pandemic. That's really stretched both labour and material supply, especially stuff coming over from mainland Europe on the materials side of things. So we're always keen to see a suitable contingency, especially in the current environment, from our developers that will cover any unforeseen cost variations. Obviously, anything can happen on a development, and we're definitely here to work with our developers. But it always helps to show that people are being, I guess, cautious on the most part and not unrealistic with assuming everything will go absolutely fine. More often than not, there will be something that comes up along the way. So we just want to see someone that's showing the initiative and being proactive in arranging those suitable costs. The cash flow itself, so just as important is how quickly they anticipate spending money on site and how quickly they anticipate building out the project. Again, this needs to be in line with what we would come to expect. We obviously employ an independent monitoring surveyor to act on our behalf and to quantify a lot of those costs, manage everything around the programme, manage everything around planning discharges, building control visits, everything around that. However, it helps with us in the way that we're funded to have a good forward forecast of roughly when money is going to be spent and how much at each point. I guess an example of that would be if there's a scheme that's a ground up build and it might be a slightly complex level of groundworks that need to be done. It might be an area with history of contaminated land, for example. That can be slightly slower and there can be quite a significant cost spend at the start. Another example is professional fees and when they're likely to be spent. If a lot of them are spent early on in the scheme, then that should be accounted for within the cash flow. And then just a point on the sales at the back end. So obviously just as important as building it is selling the units. We want to see an appropriate sales schedule, both in terms of the time that is assumed to be taken to exit the facility. Most of our schemes' main exit route is through sale of the units. Again, we take the view of an independent valuer to assist us with that, but obviously that when we're appraising the deal and potentially offering indicative terms, we expect to see a realistic position from the developer. So I guess also in terms of the actual price of the final units, that needs to be taken into account. As James touched on before, it needs to fit in with the local market as well. Next slide, please.
Great. So last one, last key fundamental is on the exit strategy. So we'd expect the developer or you as the introducer to explain how you're going to exit our facility. Part of this, we'd expect good comparables. So we want the developer yourself to provide comparables, which should evidence how they've arrived at the GDV of the scheme. And that should tie into the pounds per square foot and values they've used. They've got to be realistic on the prices. Let's not overstate the new build premium or add in inflation. We want to be relying on proven values that are already selling in the local area. Explore alternative options. So have a plan B in place. If the units aren't going to sell at the time, if the market's a bit stagnant, then as an option to put this onto buy-to-let, provide some market rentals and evidence that you could put this onto a buy-to-let to refinance that debt. And then last one is just, again, being realistic, but this part, it's being realistic on the time. So it does take time to achieve sales, to go through legals, and then for the buyer to complete, to repay our debt. So build this into the requested loan term. At the moment, it's a very good example of this, as we are seeing sales being delayed, which is a result of the stamp duty holiday and I guess COVID, with solicitors being overloaded on work and local search has been delayed coming back. Fortunately, with LendInvest, we do have the option to transition over to our bridge products, and we could look to provide a debt exit to allow you more time, or perhaps a buy-to-let if that fits. Next slide, please.
Okay, so more on LendInvest product and the terms specifically. Again, this was touched on earlier, but we'll just go into it in slightly more detail. Next slide, please. So we very much sit, as James mentioned before, within the stretch senior bracket. Currently, that means that we can lend against the GDV up to a loan to GDV of 65%. Loan size officially is between 1 million and 5 million. There is a small amount of flex on that at both ends, so we can look at slightly smaller schemes. I guess the driver for that is if there's a long-term relationship to be built with the developer and the introducer as well. So we can look at, say for example, there was a 900k development for a new developer that we're looking to scale up with, or maybe do a handful of deals with a year, then we would certainly consider that. And then likewise at the other end, we do have some capacity at the moment to lend slightly above 5 million. So it's not a flat no if it is above that. It does need to be a no-brainer, for want of a better word, to tick all the boxes. Again, it needs to be an established developer that we feel is capable of building out a scheme of that size and above. Loan term, so we go up to 24 months. Typically, a development facility won't be less than 12 months. Obviously, we need to take into account site setup, build phase, and the sales period on that. Loan to cost, as mentioned before, is one of the key things that makes our product stand out. We can go up to 90% on that. Pricing is 7.98% per annum on that at the moment, and there's 2 lots of fees. The arrangement fee of 2%, which is shared 1% each between ourselves and the introducer, and the exit fee, which is charged as 2% of the facility. It's important to note it's of the facility. A lot of lenders do the exit fee against the GDV, but we sit against the facility. Next slide, please.
And finally, with the security package we're going to look to take when we're offering our product, the typical package will include a legal mortgage. This will be on a first charge basis for development finance. We don't lend second charge for development. We'll require a debenture, which includes a share charge, and we'll look to take guarantees, which will include a personal guarantee and a cost overrun guarantee. Construction security, we'd like to think in most cases we will not require this. There should be a specific reason that we ask for it, and that's sort of a good selling point that we want to offer the market. An example of when we would ask for it is a deal that's over 5 million. We're going to look to take construction security on, or perhaps if the scheme is a self-build and there's a large contract or reliance on the ground worker, if there's a basement build or similar, then that's where we may look to take a collateral warranty. But in theory, it should only be in 1 in every 10 deals that we are requesting this on. And the final point of security is just to note that we do allow junior debt to sit behind us. That can be MES or perhaps equity if they want some security. All we require is that they enter into our standard deed of priority. An example of a couple of MES lenders that we have worked with recently is Clearwell and Rubicon Capital. Okay, I think we have reached the end of that session, perhaps ran slightly over time. We've got a couple of questions, but we'll just roll that into the next session. So after this, we're moving on to the case study session where Mike and myself will explain a few schemes that we've funded and actually provide evidence of how we actually put this into play. Thanks.
Thanks, guys.